Hi everyone, it's Grant Abbott speaking. Thank you very much for attending this session. These are my top 5 contribution strategies. These are not lame-o strategies. It's going to be pretty hardcore and also heavy hitting. And I did a session last night for a Wealth Depot up in Brisbane, which was great, and laid out a few of these strategies, got a few ideas, and absolutely blew the minds and the socks off most of the clients there. So it was a great session there with Sebastian Mazza, and had a lot of fun. I must admit, he gave me a bottle of wine, which is great. So if I ever come to do a talk for you, always love a bit of a bottle of wine as a contribution. So I was walking down to the car, and anyway, those wine packs, the bottom fell out, the wine hit the ground and just smashed into 100 pieces, and I got red wine all over my shoes, so I ended up smelling a bit like an alky. But anyway, the session went really well. Supposed to go for an hour. I ended up going for about an hour and a half because there was a lot of questions. I want to raise a lot of those issues today. The strategies themselves are very hardcore, very in-depth, so you might need to listen to them once or twice. Or more importantly, we're now starting to build our October a strategy session, which will not only look at all these top 5 strategies, but also, and I mean, go into depth, etc., but also look at our whole SMSF estate planning suite, as well as our estate planning suite for advisors. So it's a very exciting time. We've got really a lot of stuff to show you, and I must admit, at the moment, I'm even surprising myself. I'm really on form at the moment, and just seem to be really in the flow of things, and just these ideas and strategies, and building obviously the documentation behind it to make it easy for everyone is really what it's all about. I will have 5-10 minutes at the end to show you how to document it all, but let's go through the strategies first. One of the issues that you've probably heard me before is the industry super funds. I just want to cover this a little bit because I keep on getting feedback, which absolutely shocks me. And I got this last night that somehow industry funds are really great. People have had good returns in their funds, which really over the last 10 years, if you haven't had a good return in your fund, it wouldn't matter what fund you're in, it's always going to be a good return. But, dial it back to 2007, 2009, when industry funds dropped down by 30, 40% or even 20%. People were really doing hard yards, which in those days was great because people would start to make a choice and think, if I'm going to lose money, I might as well do it in my own SMSF. So you find that SMSFs always spike when the markets are doing tough. So, and it'll happen again, but it just means that the next generation is going to come in. So we're going to get the Gen X, the Gen Ys will all come into that. And I did a great session yesterday on email marketing for our subscribers, and showing how to target each and every one, and specific. In fact, I actually did a email copy to send out to clients in order to for them to send out to the clients to get appointments. But with the industry fund, can you see on the thing that was a Henry Ford quote in Model T when it first came off the production line? It was absolutely brilliant what he did, and still very in vogue today. Is that with a Model T Ford, you can have it as long as any colour you like, as long as it's black. And I thought that was absolutely classic because industry super funds have overtaken retail super but obviously with the Royal Commission, the banning of commissions to advisors, getting rid of grandfathering, it's going to be a completely different atmosphere in terms of recommending retail funds. So I'm expecting SMSFs to take off. As I've said, by 2030, there'll be $1.4 trillion sitting in self-managed superannuation funds. So there's huge amounts of opportunities. We're always going to be we're going to be compared. When they talk about compare the pair, it's no longer going to be industry versus retail. It's going to be industry versus SMSF. And for those of you who've seen me before, is the average member balance in a industry fund is 56,000, whereas in an SMSF is 660. So you can't really compare either of those ones. And really, if the market goes down, we're going to look absolutely brilliant with huge amounts of money sitting in cash. And again, I'm sure that most of you, look, I'm not an investment strategist by any stretch of the imagination, but I'm sure most of you have got some really good planning tools that if something goes down, then you will be able to recover from that. Remember, it's just simply equities, because obviously property is really long term. But at the end of the day, it's if you're in an industry fund, how many members of your family can you bring in there? Well, no. Can you do spouse splitting contributions? No. Any of the strategies I'll go through today, you can't do them inside an industry fund, and that's the difference between us. Is that that's what makes us completely different. Estate planning, contributions flexibility, all of these strategies, and I love contributions because at the end of the day, a contribution. If you can see down here, when I put a contribution, if I get a deduction, I've got money inside my fund which I can invest. So I'm getting a tax deduction for a contribution going into super to pay for a capital contribution. Now you can see there's a wee bit of difference between the slide before, the old Model T, the industry fund, and also our 2020 version of an AMG Mercedes. I'm a Mercedes man from a long way back, and I had a look at the video of that this morning. I think it's got me all pumped up. I'm pretty super excited about that. But, that's a sweet ride for all of the family, and it's a beast. It's got a bi-turbo, and that would just fly. So that would make any person proud. Now, for us, unfortunately, you can see that's the shell of a SMSF. Unlike the industry fund, you get what you get, as long as it's black. Here, what I find is most clients are focusing on investments. And as a consequence of that, they're running these AMGs or these amazing vehicles on one cylinder. And the problem about that is unless you really got it humming, you use all the strategies, really make the most of everything, that there's a lot of money being left on the table in the long run. And that's, for me, the contribution side is really important because that's getting the money in. Now, there's 3 stages of supers: getting the money in, what to do with the money once it's inside, minimising the tax inside the superannuation fund, and then obviously getting the money out, whether it's death, disability, or obviously retirement. So they're the 3 phases. Contribution is the best one because we've got, supposedly caps, we've got thresholds or limitations, etc. in there. But it's like anything, the smart advisors will understand. And when I talk about advisors, I'm talking about accountants, planners, anyone else who happens to work in this space. The smart people will actually be able to go ahead and ensure that the contributions or the strategy they're doing are not just a simple one step. So, for example, industry fund, if I want to put in my SGC, I go and fill out a form, and SGC goes in from employer and all that. That's nice, but there's so many different things we can do. We might choose to split that to our spouse the next year, which has an impact because that then delineates and starts to legitimately split stuff over, so we can then maximise our T-bars in effect. And I'll look at that a little bit later on. So we've got all these possibilities, but again, it's also incumbent upon you absolutely to make sure that you keep on top of things. I love going in and finding new rulings, new ideas. Yesterday, I found a private binding ruling after Dan Butler, I read, in fact, it was a couple of days ago, wrote an article on the problems about adult children being interdependents. Of course, I mean, adult children aren't supposed to be interdependents. It's even a ridiculous idea to countenance that fact. I mean, it's very hard to get them under that. But for an adult child to be a financial dependent, there's a whole list of cases. There's a whole list of ATO rulings on this. And I found a beautiful private binding ruling back in July 2017, which shows how easy it is for adult children to be financially dependent thereupon being a tax dependent inside an SMSF. And I'll be going through that at a later stage, obviously, when I come around to the October Roadshow. Fit within the Commissioner's guidelines and bang, you're in there. And that's essentially what we all want to have a look at. Now, when we have a look at contributions, as I said, you can make deductible, or you can make non-deductible. Non-deductible can, of course, include spouse contributions. So not really a big fan of those. I mean, they're good, but you've got to have your spouse under, I think it's $40,000 or thereabouts of taxable income, which for high net worth clients, it means if they're there, you're obviously not doing the right thing unless they're fully retired. And if they're fully retired, you can't make a spouse contribution anyway. So really, it's not a big one. Grandchild, grandparent contributions, in-kind, excess contributions, reserves, and the list goes on. I mean, from our perspective is when we're looking at getting that money in, and it's not just money in, we also look at loans, which I'll look at very shortly. So there's a whole lot of opportunities, abilities in there. And look, again, it's just just come to these sessions of mine. You're going to listen, learn, and it'll open up your eyes. And again, it's up to you whether you take away these things and apply it. So strategy number one is the parent. We love our parents, of course we do. Someone actually said family means father and mother, I love you. So that's family. Don't you love that one? Father and mother, I love you. I try to teach that to my kids, but I'm not sure if they listen to that to any great extent. Now, in order to be a parent or make a contribution on behalf of a person, we can be an individual running a business. We can operate in a company or trust, obviously, for asset protection purposes. But provided there's a business, and the business it's actually a business and it's an Australian business, then effectively anyone who's employed you can make a tax-deductible contribution for. In fact, if any contribution, I'll just take a segue here. So close down that thought on deductions. Let's switch over to contributions. Any contribution that goes, if a member makes a non-concessional contribution into super, effectively it doesn't form part of the fund's taxable income, so that's not part of the so-called contributions tax. If anyone else makes a contribution into a fund, and anyone generally, unless it's a child contribution for a child under 18 or a spouse contribution, it is going to be treated as effective, or government co-contribution as well, sorry, it's going to be treated as a concessional contribution. So, for example, if I contract, let's take, and this is a good one. Let's say you're doing my accounts, and so we do that, blah, blah, blah. We come around and you do my accounts, you charge me $3,000 for my super fund. Way too much, guys, way too much. $3,000 for that. And instead of receiving cash payment, I put a superannuation contribution in on your behalf. Am I able to do that? Absolutely. So there's no limit on who can make a super contribution on your behalf. What will happen is when it goes into the superannuation fund, it'll be treated as a taxable contribution, obviously. And then obviously we need to work on it, minimise our tax liability inside the fund. So using franking credits, SX, capital appreciation deduct, all that sort of stuff. It depends on working in the fund, but that's not the subject here. So likewise, if we have a look at it, any individual company or trust running a business will get a tax deduction for it. If I'm running a business and I make a contribution on your behalf, I'm going to get a deduction because it's for services rendered. So good little strategy on that one. When I go down that track, if I'm offshore, it's a little bit different because you have to earn assessable income in Australia. But anyway, so Section 290(60) of the Income Tax Assessment Act gives me a deduction. Now, the thing is, the way the system works, and again, what we do is, as strategists or as strategic SMSF advisors, we always game the system, or we're playing the SMSF game. So we need to work out, is there a limit on deductions? Well, effectively, when we go down the track, really there's no limit on the amount of deductible contributions we can make. And I'm going to look at Ryan's case. So I've got Ryan versus Commission of Taxation 2004. A good friend of mine, Robert Richards, actually worked on that case. And we're going to have a look at it next slide, because the next slide I've just put an example out of TD 2005/29. So see that, have a look at it, remember it, and put it into your mind, because it's the most brilliant contribution strategies ever. So if we've got a client, if we've got our parents working for us, so they can work for us up to age 75, obviously, because once you go over age 75, unless it's SGC, you can't make a contribution on their behalf. If it's before age 75, of course you can make a contribution on their behalf. Remember, between age 65 and 75, they've got to be working for 40 hours over a 30-day period, as per regulation 7.04 of the SIS regulations. Under that, there's no work test. But obviously, in order to make a contribution, you have to get them employed. They have to be showing work. Even part-time work is really sufficient. Once you get between 65 and 75, then obviously it's going to be, you have to make that at least 40 hours over a 30-day period in order to make a contribution. Now, the big issue there is that the amount of work, normally if it was a parent, and for example, if I employed, well, I can't employ my dad because he's in a nursing home and he's also 86. But if I had a parent who was 74 and I employed them, then from that perspective, again, they can come and work for me. But if they worked and did like 20 hours a month, for me, or 10 hours a month, coming in, tidying up the office, cleaning up. And my mum can do that too. So mum comes in, looks after me, has child minding, blah, 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 all that sort of stuff. Then if I went to pay them $10,000 a month, then effectively that would be treated, if it's a company, if it's a company or as a trust in certain circumstances, it would be treated as a deemed dividend, and therefore it would be an unfranked dividend in their hands. So that's a huge no-no to anyone's stretch of the imagination. But what we can do from that perspective is we can also, so that means that they miss out on the deduction, because it's an unfranked dividend. But if it turns to super, in Ryan's case, there is no limit on the deduction or the reference to the amount of work conducted, as we'll see very shortly. So we can employ parents or grandparents, depending on the age. So this is where family comes in, because again, we have a look at the whole family unit. So for example, you could have a 40-year-old who employs their 70-year-old father, and they make a $70,000 or $80,000 contribution, a deductible contribution on their behalf. That means that the father, it'll be included in the fund's assessable income, as we said before, in that instance, because we're getting a deduction. The family trust, the individual or the company that employs the father, and we'd like to make sure we see a good employment agreement that allows that salary sacrifice. Basically says there's no salary, everything's to go into super. When it goes down to that employment agreement, effectively what we've got is the money goes in on behalf of the father. Again, there's limitations on what we can do. But again, if we breach the caps, as you'll see, it just gets returned to us anyway. So there's no limit on the deduction. It's accessible inside the fund. And then we go down the track. Now, the beauty about it, if our parent is over age 60, then provided they've met a condition of release, and I'll talk about that in a couple of slides, then they can pull the money out. And if they can pull that money out, then effectively it comes out completely tax-free, which is a great way, because this goes in accumulation, can be pulled out straight away, or can be left in there and then floated over into the pension, depending on their T-bar. So again, what we're starting to use is our parents and start to use their T-bar caps, of course. We have to be sure, we have to be careful of any, obviously, their ability to contribute. The cap, the general contributions is 1.6 million, or their balance inside that fund. If you have a look at that general superannuation balance is 1.6. So you've got to be very careful about going above that. But more importantly, it's deductible. But if they're over age 60, already retired, they can pull the money out. As opposed to exception, and this is where we're going with some of these contributions, I'm going to show you how to make contributions into super and effectively release them at a latest, at any age. Doesn't matter whether you're 18, 20, 25, 35, 40, etc. But the benefit of obviously being a parent, once they're over 60, they're retired, they can still be employed. They can be employed up to age 75, but again, we go down that track. Now, what I would suggest is a leading member SMSF. I haven't got time to really go into it at this stage, but make sure you come along to the October roadshow for that, where we will be looking at the contributions, but also the leading member. In short, if you're going to make a contribution on behalf of your parent, that's money coming into your family trust company or wherever, you need to be in control of that process, particularly if there happens to be a death benefit. And really the leading member is the key member inside a fund who actually runs the fund, has complete veto power, can hire and fire the trustee, hire and fire members, much the same as an appointor, or what we call a leading member appointor in a family trust. So if you're going to put this strategy in place, you need to upgrade your client's deed to a leading member SMSF. I would strongly suggest that, because again, a lot of this componentry needs to be put in place, because one small problem and the whole thing falls to pieces. So that's the parent. This is comes straight out of ATO 2005-29. So what I'll do is I'll just get my little bouncing ball so you guys can see it. So this is example, paragraph 14. Have a look at this, ATO 2005. We'll put these slides up so you can have a look later on this afternoon. That'll be up in our LIghtYear Support Centre, which I'll show you. Mary is a computer consultant who provides her professional services through her private company to a number of clients, all of whom refuse to contract with her personally, but insist on obtaining her services through a contract with her company, which is fairly typical. The company employs Mary to provide programming services to its clients and employs her husband, Derek, to provide administrative support. Derek obtains a market value salary for his administrative work for the company, but the company provides superannuation contributions on his behalf to a complying superannuation fund up to his age-based limit of 95,980. Now, this was way back in 2005 when we did have age-based limits, so it's still the same. The company provides the remainder of its fee income, net of expenses, to Mary as remuneration for her services. Mary's remuneration consists of salary and a superannuation contribution of $4,500, representing 9% of her salary, the minimum level. Anyway, you guys know that. Mary's salary is lower than it would have been if the company had not made such a high superannuation contribution on behalf of Derek. However, Derek provides valuable service to the company for which he is fairly remunerated. The company makes genuine super contributions on his behalf, and there are no unusual features of the arrangement. In the circumstances, Part 4A does not apply. So let's give the Commissioner a clap for that one. That really, again, if you go through and have a look at that TD, it really goes through in depth in Ryan's case and really elaborates on Ryan's case and comes up with this example, which is absolutely fantastic when you see Mary's actually getting less than her husband, Derek, who does a few admin support services and more importantly gets paid salary for it plus gets superannuation. So I'm a great fan of that one. Have a look at that. Again, there's these little gems the Commission's put out in the past. So next one is the asset and income switch. So here we've got clients who might have an asset outside the fund and we want to switch it into the fund. So it's not a bad idea at the moment because while asset values are reasonably high, there hasn't been any market correction. You've got more opportunity to get more tax deductions for your buck if you understand what I mean. So obviously we have to watch out for Section 66, but we can transfer in shares. So generally listed shares, we can do business real property, so flexible business real property. That can extend to business bed and breakfast. So for example, if a client's got a residential property and you can show they've got a business plan, they've set it up for a while and they do a bed and breakfast, that becomes now a business real property. Ostensibly, you need to do it right and make sure you do it right, but it's still there. Sheds they might have, that's business real property. If we've got a farm, you put some chickens on it, as a good friend of mine does. Effectively, that turns land into business real property. Last night we did in the session, one of the clients there had land banked some farm down in Chermside, land banked some land in Chermside and was going down the process of looking whether they can transfer it to the SMSF for a number of reasons. But part of that was we need to make sure that the client, because you can't transfer just land in until you become a land developer. So once you go through that process of becoming a land developer, again, if you have a look at the Commissioner's business real property ruling, have a look at the examples, it actually talks about land being able to be transferred into a self-managed super fund. Likewise, if you've got a number of residential properties sitting outside of superannuation, they can be transferred into superannuation provided their business real property. And again, what we need to do is show that we're in the rental property business. So from that perspective, it's a good opportunity. You can get rulings from the Commissioner. I've seen ones for 5 or 6 properties being able to switch in or be able to be classified as business real property. Now, obviously, we have to watch out for CGT, but remember when we put it in, if I put in a property, let's say I choose $100,000 of shares. So I'm putting $100,000 of shares into my superannuation fund. There's a $50,000 capital gain on it. So I take my 50% discount. That means I've got a $25,000 taxable gain, which is included in my assessable income. Now I put $100,000 of shares in. So what I can do is I claim $25,000 of that as a personal contribution, a personal deductible contribution, and the rest can go in as a non-concessional. So does everyone understand how that works? So $100,000 of shares, I transfer them in specie over to my superannuation fund as a contribution. What happens from that perspective is I work out the capital gain. The capital gain is $50,000, so they've done quite well on that. But we add our discount, so that now takes it down to $25,000. That $25,000 I've got there. So on the contribution, when I complete 25, the individual will classify or claim a personal tax deductible contribution under Income Tax Assessment Act Section 290(150) for only $25,000 of that. Obviously, they've got to give a notice to the trustee of it, and when they do that, there'll be $25,000 which will be concessional, and $75,000, which will be non-concessional. But now obviously the shares are basically sitting inside the fund. Now, what you've got to do is watch stamp duties. Obviously, on shares, it's not a big drama. But if we've got a property that's worth $500,000, it's got a $250,000 capital gain. And again, we go through the process. So there's a $125,000 tax deduction. Then we transfer the $500,000 property and claim a tax deduction for $125,000 to get rid of the capital gains tax. Now, of course, that's going to take me into excess, but that's fine. I'm going to look at that a little bit later on as we go down the track. But what we do have to watch is stamp duty. So that transfer over, effectively, what will happen is that we may be up for stamps depending on where it is. If it's in Western Australia or it's in New South Wales, if it's a commercial property, if it's in South Australia, I think to a lesser extent Victoria, there's no stamps because essentially it's for the benefit of the members being transferred in. So just got to be careful on that one. If it's from family trusts or companies, it's a completely different issue with stamp duties. Now, it becomes assessable in the fund. Remember, we transfer the $100,000 of shares, $25,000 deduction, $25,000 of taxable income in the fund. We need to ensure that we effectively get tax relief to wipe out that tax liability. $25,000 of assessable income at 15% inside the fund is going to be about $3,750. So on $100,000 of shares, if they are, for example, NAB shares or ANZ Bank shares, you're going to find the franking credits will actually cancel out to an extent the contributions tax liability. With the property we're transferring in, well, hopefully it's got capital allowances, depreciation, etc. And obviously there may well be a borrowing. If it's all wholly in specie with no loans, then we are going to be limited on the amount of relief we get. So hopefully there'll be other parties inside that fund, that leading member fund, that will have that ability. What we have done, though, is essentially, if we look at it from an overriding perspective, and is that we've moved an asset, which when we have an asset's got two aspects, unless it's gold, for example. Generally, it's got the tree and then there's the fruit from the tree. So that's a very famous income tax principle. So the fruit from the tree is generally taxed as an income stream. So if it was sitting outside, whether it's the shares, whether it's the rental income from the business real property or residential property companies, then effectively what will happen there is it'll be taxed at marginal rates, depending on what you're doing outside with its family trust. But if we switch it into an SMSF, the maximum tax rate is going to be 15% on the income. Or if we can sidle it over to the pension side, then effectively it's only going to be, what's going to be zero tax. So again, by switching that asset over, it can have a huge impact, depending on our T-bars, etc., on our overall family tax liability. Combine that, of course, you can use this and we can combine it with our parent if we see fit, depending on what assets in the family trust or company or individually. Now, this is strategy number 3. I'll call this the release, which is really important. As I said before, if you're over age 60, then basically you should be up for retirement. So I've done a couple of cases. I just did a letter of advice on this last week through TGA Legal, our legal firm that signs off all the documents of LIghtYear Docs. But essentially, we've got a commission's ruling, got guidelines from APRA, etc., that once you're over age 60, if you give up one form of gainful employment, even if you're still working full-time, then your existing benefits in your fund, any preserved benefits, will become unrestricted, non-preserved, so you can access them. That can be then used, obviously, to pay a pension. I'll talk a lot about that more at the roadshow. But in essence, what will happen from there is that any future contributions will obviously become preserved, and then you have to meet another condition of release. But at age 60, we've met the condition of release, given up one form of gainful employment, bang, we're right in there, and we're off and running. The problem is, well, that's great if you're over 60 and you've got that release. If you're before that, it's very difficult between age preservation age and age 60, which really is, I think, 58 and 60 anyway. You have to show retirement. But if you're under age 58, so you're under preservation age, the only way you can really access your superannuation is on death, temporary incapacity, permanent incapacity, or terminal illness. So that's something I would definitely not recommend to clients in order to access their super. Maybe their kids might think about it at a later stage. Now, here's the deal, and for those of you who might have seen about 3 weeks ago, I did a whole strategy and went through our advisor-made or a created installment warrant strategy, which is sitting on the LIghtYear Docs portal, which we can't do today. But if we go back to this slide here, which makes a lot of sense. So we've got the asset and income switch. Remember, if I just focus in on the shares, so that I've got $100,000 of shares, whatever it is, I'll transfer it in. Remember, I did this $100,000 in there, $50,000 of capital gain, slice that in half, $25,000 deduction, and I'll put all those shares sitting inside the fund. So everything's A-OK. Now, for someone age 60, absolutely crucial. The problem about that is if I did that outside the fund, because I've got no stamp duty or no capital gains tax, so and remember the franking credits are now going inside the fund to wipe out the contributions tax liability, and they'll be able to then, next year's contributions tax liability will be able to be wiped out again. So it's an absolutely pearler of a strategy. So for any clients who are under age 60, particularly if they're working under age 50 or 40 or 30, and they've got a share portfolio outside, doesn't make sense outside. What we need to do, though, is the big fear, the big myth is, oh my God, it's in super, I can't touch it until I retire at age 65. And that's just a myth. Because this is what we do, is we pass it up. So we're going back to the same one. What I would do is give the client the ability to work out, from that perspective, what they want to do. So they transfer $100,000 in. So if we look at the Commissioner's ruling, effectively we can do an LRBA over those shares of up to 50%. So the LVR is 50%. They're our shares. We're lending those shares. So it's a share lending strategy going into the self-managed super fund, where we then take, obviously, the franking credits. So they need to be in there for at least 45 days. But after that time, bang, it's releasable. So, for example, let me go back again, $100,000 of shares, but $50,000 of it is an LRBA. So you jump on our site, you do your LRBA, your installment warrant. For those of you who are on unlimited packages, or on our license, which seems to be the preferred way of going, where you've got unlimited documents and strategies and training and all that for 1, 3 or 5 year period, a very inexpensive price. You can just build that installment warrant. Now, that's a lot smarter than number 2 for anyone there, because not only have they got the tax deduction, they've streamed their income into a self-managed super fund, but they've also got access to $50,000 of capital at any point in time, provided the loan agreement allows, which ours obviously does. You can pull money out of that superannuation fund. When it comes out, it's tax-free because it's a return of your loan balance. So I love that strategy, because it's something, and I showed someone last night, and they were just absolutely blown away, because it means they've got the best of all worlds, the tax benefits, any upside on those underlying stocks. Obviously, what happens there is that goes into a concessioning tax environment for the retirement. So they virtually just lent the stocks in there. Now, here's the thing, is if the stocks go down, or they drop down by 50%, then everyone just walks away from the stocks, give the stocks back to the individual concern. The super fund takes a capital loss on the deal, and everyone's happy. And our member, our person outside, has now got the stocks at a lower cost base. So absolutely brilliant strategy for my one, and I love the release. I'll go through it a lot more, obviously, on the October Roadshow. Supermax. Well, you tell me, what happens if I make a $1 million tax deductible contribution? Obviously, I can. The law says it. Go and have a look at Section 290(60) for the employer, or 290(150) for personal contributions. In either of those cases, there is no limit on the tax deduction which is allowed, and that's what I'm focusing on. So this is for the hardcore people who really want who really faced up to having a huge capital gain, a huge disposal that's fitting in there. So it's really the end. But if I stretch your imagination to $1 million, it doesn't matter whether it could be 100, or it could be 50, or it could be 75, or it could be 150, 200. It doesn't make any difference. So what I'll do is I'll put in $1 million. It's pretty out there, but again, it squares with the law. We've got all the Commissioner's rulings that basically say that. Now, what will happen is fully deductible. And then now the problem is the amount that is over our concessional cap, which is $25,000, so that's going to be $975,000. Effectively, that is going to be added back to our assessable income. So we add it back to our assessable income. So the way it works is the client's going to get their first income tax assessment, which is going to be based on the lodgement of the return. Then the super fund lodges a return saying that they've got $975,000 of excess concessional. Wrap that up, and then that's sent into the commissioner. The commissioner comes back and says, oh, okay, well, that $975,000 will add back to your assessable income, but on that, we work out our tax payable, but inside that particular fund, what will happen is we're going to get a tax offset, and I'm just jumping into my calculator, so I just want to show you something. I get a tax offset, which you'll find under the section 291, so excess concessional contributions. I get a tax offset of, let me just clear this, 975 times 0.15. I get a tax offset of $146,000. Now, mind you, that's based on the fact that, or premise that there's been 15% tax inside the fund, which would be the case if you're industry or retail fund. Now, again, if that was $1 million of shares that were transferred in and they've got franking credits, then we're probably not in a bad position because we can get rid of that offset or invest in early stage innovation companies, so on and so forth. So these are really good strategies. I know I looked at it a couple of weeks ago on high income earners. These are great. Sit down and, sorry, that's my dog at the moment. She's gone freak because someone dropped something downstairs. So if we have a look at that, then effectively we will be in a position of including that offset, and then we've got to work on our contributions tax. Now here's the deal. See the last one down here? I'll get my little red button there. Sorry about that. That scared the hell out of me, the dog. Damn dog, be quiet. Anyway, from that perspective, what I'm going to do is, from that perspective, sorry, I just got rid of it. When we have a look at it, the non-concessional, excess concessional, so to the extent we go above the non-concessional caps, which in this instance is going to be quite significantly, because once we go into excess concessional, that 975, that's also treated as non-concessional. Now, if they've just got 100 in their cap, or if they're over 65, 75, they've got 100 in the cap, that means that there's going to be, sizable amounts, $875,000, which is excess non-concessional. So at some point in time, the commissioner is going to come back and say, okay, well, that excess non-concessional, you have to take out of the system. Now, what will happen is 9% of the underlying contributions amount will be added back as accessible income. So that's the gain that's supposedly derived. But you've got full access, full freight access to it. Excess concessional anyway, from perspective, even if it was under the 300 bring forward, so that they are well and truly below their caps, then effectively from that perspective is that the client is going to be able to access 85% of their excess concessional. So they'll be able to pull that out. Again, it's another release mechanism that most of us don't think about, is that when we put in our contributions over our thresholds, which is the 25,000, at some point in time, 85% of that will be transferred back. So that's if I've taken the deduction for it. So again, it's not a bad strategy for clients who are much younger, who won't be able to have that. Effectively, that contribution, if you look at it, is virtually in a preservation suspense account. Does that make sense? A preservation suspense account. When the commissioner comes back, you've then got 60 days in which to tell the commissioner to release it. If you don't, then it becomes fully preserved. So again, I love that Supermax strategy. Just as an aside, I'll be doing a lot of these strategies at a high level at Class Super on the 9th and 10th of September in Sydney. If for those of you who are going to be there, make sure you come up to our stand, have a chat. If you've got any questions around all of this, or you've got strategies for clients, hit me up. I'll be there all the time and live strategizing. Or I'll be there at Tim Munro's next week, which will be a lot of fun. So it's Change GPS on Monday at the Convention Centre. If you haven't got tickets for that, go to Change GPS. Strategy number 5, super spouse. Well, where we've got a spouse, we throw everything at the wall. Given the fact we've got T-bars, we're really going back to 2007 where we had our reasonable benefit limits. So we want to start to equalise. We can do it to a less extent with reserves. If we've got money in contributions to reserves, we can start to super split that. So if we have a look at that, don't worry about spouse offsets. Well, you can if someone's got under $40,000 of income. But super splitting low tax contributions only works up to 25%. 85%. So if you've got a client who's actually taken an amount to a contributions reserve at June year end, sitting inside a reserve, 85% of the amount that was deductible to the member can actually be split to their spouse in the next financial year. So you've got a huge amount of time in which to make that splitting happen. Again, it's only a certain amount, but again, we can get the spouse working much the same as, remember the situation of the computer consultant and their husband, how they effectively, she loaded everything up into his superannuation account. So again, we can go through that process and we can go up high. Remember, we can go to parents and we can also go down to grandparents. Again, if we start to look at this for the super spouse, depending on their age, if they're in the accumulation stage, and there will be some stage that, depending on the age difference, it may be better if we split up to an older person who has full access to it, unless, of course, they've already hit their caps and left in accumulation. We want to start to balance the two out. But if there's an amount sitting over on pension side, amount in accumulation, we can actually have a look at it. And the smart thing to do is work out what the assets are. So, for example, if I'm making deductible contributions of shares or whatever, and I've got a portfolio and those shares actually look as though they're going to really take off, why wouldn't I put that into the spouse's sub-fund, which we find under our leading member, our ordinary SMSF deed that we produce at LIghtYear Docs, and effectively you're off and running there because any growth on there goes to the spouse. Anyway, if I go from there, and what I'll do is I'll just take you through a LIghtYear Doc package. The document I'm going to show you, normally all of our docs are $99, but the contributions I'll take you through now, show you how that works really quickly, because all of the strategies are good before, but you need to document it properly, otherwise the whole thing falls apart. It's $99 a document, $5.95 you just want unlimited documents, or really we're finding our license situation is probably the best. If you want to have a chat with a license, just contact me at Grant at ilovesmsf.com, and you can get a license of all our documentations and CPD for 1, 3 or 5 years, and really it all becomes self-funding after you make the first payment. And I can show you how to do that through an SMSF as well. So if you don't know how to do that, please feel free to contact me. So what I'm going to do now is just take you through the last 10 minutes to the LIghtYear site. As you can see here, I've got the site. I'm coming in as a LIghtYear basic, so I've paid up a lot of credits there. I've got $490,000 of credits. That's quite sizable. You can use that if you're an unlimited user. Absolutely use $490,000. So we've got a contributions to expense account, which is a reserve, or contribution to benefit a member. So I just go in there. It goes through about the product, general information. The cost is, as I said, $49. The benefits and frequently asked contributions. This training that I'm doing will actually be sitting up here. See the support centre? So the support centre, if you want to look at any trainings around our strategies, go to the webinar how-to videos. You'll see their advisor-built instalment warrants. So if I go into that section there, that's the one that we talked about working out how to do that, and more importantly, showing you how to use that on our system. So if I go back to LIghtYear Docs, I'm going to buy the document. I'm going to have to put it into one of my client folders. Ashley told me today that effectively we're now hooked in with CAS 360. And certainly my class will be there very, very shortly as well. So it's going to make things a lot easier. So I'll just go down, I'll go through the process. Now you can either pay by credit card, but I've got credit there anyway. If you're unlimited, you won't find that, it'll just pop through. So this goes into our system. Again, this is when we have a look at it, we'll put the super funds details down. So we'll put the Smith Family SMSF. What's the full name of the member? So what we're going to do is John Smith. The trustee is a company. So we'll just go through here and put Smith nominees. We don't need to put in the PTY Limited. We enter the ACN and follow it up as you would see it normally. Sorry, 789. Again, if you are with CAS 360, then you'll be able to pull a lot of these details straight out of CAS 360 and pre-populate it on your behalf. So New South Wales. In fact, I'm looking forward to going to Sydney. Haven't been to Sydney for a while. So if you are going to be at class, make sure you pile me up and let's strategize around some of these things. Because really a lot of these contribution strategies, the reason I'm doing them now is that it is the absolute prime time to do it. So I need to put in, I've got 2 directors. I put in there, I confirm. And the first one is going to be John Smith. Is he going to sign on behalf of the company? Absolutely. So tick that. And then the next one is Judy Smith, his wife. And will they sign? Yep. And sign there. So I won't know tick. So then we go down to the trustee meeting. So I'll leave that blank. If you leave it blank, I don't really know what it is. Who attended the meeting? That's obviously John and Judy. And what happens is the process, and this is important, the process is when we get to the documentation, there's an application and then there's a trustee meeting. So what we're doing now is we need the details of the member, which we did in that first field, and then we'll find out the next field is the next interview questions will be what sort of a contribution is being made. So we know it's on behalf of John Smith, who chaired the meeting, John, and I can select, because I already know if I just press that button, that will auto-fill for me. So I'll then go to the next one. Now, we're going down to who's a contributor. It can be an individual, a company, or trustee of a trust. So let's just go down a company, and we'll call it Smith Investments. So I'll just get rid of that. So Smith Investments. So we put in a new ACN. Again, let's say it's the same address. So Smith Street, Sydney, New South Wales, 2000. And we'll just have the sole director for this investment company and we'll call it John Smith. So that's fine. So that's the contributor. So this is the party making the contribution. So the next one we go down to is, remember we've got a company. So please enter the date the member is going to be applying to make the contribution. And obviously that's going to have to be on or before the date. If you have a look at here, this is the trustee deciding. So this is the trustee deciding when to make the contribution. So the member is going to be applying. So let's just say it is tomorrow's date. What is the date of the intended contribution? Let's say it's again going to be that $100,000 of contribution. Oh no, let's just say it's $25,000. So the company is making a $25,000 contribution. It's concessional, and it is all going to be in specie. And let's say that it is 25,000. Remember, because this is an investment company of BHP shares, or I could just put shares if I don't want to actually name it. So I transfer that in. It's a concessional, so the company's getting a deduction for it. Shares, I can do in kind. Cash, obviously, we know what cash is. And I can mix it, so it could be like $10,000 of shares and $15,000 of cash. In kind is, for example, you'd write in there where the employer, in this case SMSF Investments, effectively pays the fees or the audit and accounting fees for the SMSF. So that's what we're calling in kind. So you have to make sure your deed has got that. Here we're just doing in specie. It's concessional, and then that's essentially it. So I will pop the document, and then the document, generally the best thing to do is on the way through, always try and save the answers, just in case something happens, and you can always go back. But this will actually be in the vault, so it'll sit in the vault. As you can see there, we've got contributions to a fund for the benefit of John Smith. It's in the family, Smith Family SMSF. I haven't put any blurb in there. I would put the Commission's contributions ruling 2010/1, but I haven't put that in there. I've just gone straight into it. So it's an application by Smith Investments to contribute to the member. We've got the name of the fund, and if you don't have that application and simply, well, if you don't have any of this documentation, then you're in real strife, because effectively it would not go in as a member contribution. It should actually be sitting in a suspense account. And then you have problems, obviously, with 7.2 of CIS regulations that effectively will breach the governing rules as well as the CIS regulations. So all manner of problems would happen. So we do the contribution. We've got John Smith. We've got the contributors' details, $25,000 concessional in specie shares, signed by the member and also signed by the contributor. So it's agreed to by both parties. And then we've got the trustee meeting application. So same thing, John and Judy Smith attended. We've got John Smith. John Smith was elected as the chairman. Again, it's going to be make the contributions, concessional, 25, in specie, etc. And then obviously it's a trustee resolution, so signed and executed by the trustee of the super fund. So you can see there, that only takes 2 minutes. If I go back and have a look at if I go back to show you where we go, so I can go back to home, where this is. I can go in here. I'll go to my vault, and inside the vault we go to the Abbott-Family. Bingo! It'll actually come up here. You can see there my contributions to benefit a member. If I want to go and relaunch that, I just click on the plus button. See the little rocket ship, so that opens for 30 days. So if there's a change or you want to pin in more or whatever, then you can go through that process. So remember we had this. So this is something I just did for you 5 minutes ago. I've got still the trustee meeting, but what I can do from this process is who's making the contribution. I could actually change this to an individual, and it could be a spouse contribution. So I can go through the process, and that will then change our documentation. I can do employer, because if it's an individual, they can be employers, personal or spouse. Company, effectively, it's going to be always concessional. Remember, because we said of section 295(1)60, it's including funds income and also the trustee of the trust as well. Anyway, we're probably right at that point in time. I've got to go and jump and get a plane. But have a look at this again. This will be up later on. I will be in transit, so I'll try and load it up as best as possible. But that really shows you how powerful contributions can. To get a deduction can you believe that? To get a deduction to clear out tax by simply transferring shares from one to another using that LRBA, if you want to do that. If I go through and have a look at here, I'll go back home. I have a look at my strategy automation. Corporate trustee and deed upgrade, the related party LRBA shares. I can go through that process. If you're going to start to do a lot of these, you're better off getting a license or unlimited docs from us. Again, please feel free to call me on that one. Anyway, that's enough for today. And it's Grant Abbott signing off. And thank you very much for attending. You may need to watch this a bit further. I'll make sure you come to our October roadshow. It's going to be absolute awesome. I'm really on fire with the strategies at the moment and really looking forward to sharing all this with you. And once we start to combine it all along from the contributions inside the fund and outside the fund, it's absolutely awesome. I'm going to show you how to blend family trust, a leading member family trust and a leading member SMSF together, so that when someone's retired, you don't roll back, you should actually roll out. So a lot of fun there. Anyway, it's Grant Abbott signing off.